The economic reality is the big worry out there is how much can the Chinese economy decelerate? And I think also investors get very fearful because there still is that underlying tone of what is the transparency into the underlying Chinese economy and what is the data and how is that reporting? It is maturing, and that's part of the struggle here in addition to the trade policy, but the actual impact of tariffs, if you talk to steelmakers or automakers, it can be material, it can be disruptive, but as a proportion of the total economy, it's much smaller than the aggregate Chinese economy decelerating. And I think worrying about some possible policy mistakes in China that may have happened over the last 10 to 15 years to stimulate this growth, we've learned the hard way. Policy mistakes take a long time to manifest themselves in the economy. And there are, I think there's a camp of market participants out there who look at China, and that's an underlying fear. And when you see deceleration and perhaps lack of visibility on what's going on, that's why it can push down the market in the short term.
Karyn, what do you think?
Well, I agree. And I think that the China deceleration is definitely on investors' minds, but also that whenever China decelerates, they're going to stimulate some more. So it takes a while for that stimulus to work through the economy, but it will work through the economy, and we've seen this play out before in 2015, 2016, and then all of a sudden we say, oh, wait, things are better in China, and here we are in the United States, and we've been pricing stocks very low based on all the risk, and then we see the market take off. So even though China, the bad news in China is actually good news in that there is going to be more stimulus on their part, and we probably will see an uptick in the China economy sometime in 2019.
Kevin, you think stocks look a lot more reasonable and look like a fairly decent bargain at these prices. That means you're not worried about the economy really falling off a cliff?
I find it very difficult to see how the U.S. economy enters into a recession in 2019. There's been a deceleration in expectations of aggregate corporate earnings. That's what the market really has adjusted to. The volatility and sell-off has been more about sentiment, less about fundamentals and valuations. So we're seeing earnings growth this year is going to be north of 20%. Consensus now is looking at 8% into 2019. Consensus has missed earnings quarter after quarter by a wider amount over and over again. So valuations have been derated. Fundamentals are good. I think one of the biggest takeaways from Q3 earnings was profit margins actually went up a little bit. And even if they come down, I still think that the multiple derating plus profitability still being at record highs makes stocks potentially appealing in some segments. The other underlying thing we're looking at, deceleration in corporate earnings. The market's been adjusting to that. But the U.S. consumer is confident, under-levered to some extent, and spending. So even if you get a deceleration in corporate earnings, the U.S. consumer can potentially still keep the aggregate economic activity going.
And Karyn, that's your point, too, that the U.S. consumer is really the wild card here. We are looking at earnings that are expected to be growing again once again next year, but it's really up to the consumer. So if you're dealing with a situation of market sentiment and consumer confidence that may be waning, how do you kind of play that?
Well, I think that when consumers in the first quarter, when they start to get their tax refunds, they're going to say, I have more money in my pocket than I even thought I did. Consumers are strong, and it's primarily because the jobs market is so strong, and consumers that have jobs are happy consumers. So even though the market sentiment is bringing consumers down a little bit, and even though we are decelerating a little bit, we're still growing. It's still a robust economy. Earnings are still advancing. So I think it's just been a little bit too much of the negativity. We're definitely in an adjustment period because the Fed is ripping off the Band-Aid. Nobody likes that. But I think we're pricing in all of the bad and not a lot of the good. And in fact, what we're calling it right now is the storm before the calm. So I think that things will be a lot better in 2019.
Karyn, you've been positive for a long time. Have you been putting extra money to work as the markets have been in this volatile state and really come down pretty significantly over the last couple of months?
Yeah, well, I think investors should be fully allocated because the fundamentals are so strong. But it's hard for investors to buy low. I know people think it sounds easy, but when the market is going down, it's not always easy to buy those stocks. But there's so many good things that are out there, so many companies that their earnings are very strong, and they're not being rewarded accordingly. So we've been fully allocated, and we think that a lot of this bad is already priced in.
You say it's hard for investors to buy low. You think these are the lows?
I think we're getting somewhat near the lows. I don't think we're out of the woods yet, but I think that we see the Fed is looking at inflation. I think there's a chance that there will only be two rate hikes in 2019, and that underlying economy is still strong and those corporate earning fundamentals are strong. So I think that investors are going to say, well, we already have been priced in all the turmoil with China, and we could be getting something good out of that. The Fed could pause a little bit, and geopolitical risks could subside. We do have a lot of turmoil in Europe with Brexit and with Italy, but hey, we could get a positive resolution or somewhat more positive. And there's always those global risks out there. And if you wait for them all to be settled, you'll never be invested.
That's true.
So I think investors are really pricing in all of that right now. And that's why I'm calling it the storm before the calm.
Hey, Kevin, I'll ask you the same thing. You think we've hit the lows?
I think we need to see volatility decline. So investors have gotten very used to a lower risk environment in U.S. equities for some time. This year we've had 57 days with a movement more than 1%. I think in 2017 it was around 9%. Mm-hmm. We just hit the 30-year average for volatility on the S&P. So I agree with Karyn. We're getting near the bottom. The market has to rebase itself. Some of the technical action you've seen recently would illustrate that. But you'll see more elevated risk in 2019 than the past 5 years. But we should be seeing risk levels decelerating, and that'll signal the bottom.
But you do think investors are getting used to this new normal, with the new normal, I should call it.
Right, and part of that new normal has been throughout a lot of the volatility, there was no rotation in leadership. We've begun to see that in healthcare stocks and companies and investors putting a premium on returns on capital and profit margins. There was a lot of momentum in tech-led up until this volatility hit.
We thought that the next leadership would be the financials, especially if the Fed was in a raising rates sort of position. That has not been the case.
It's been the opposite. Yeah. It's been very tough. Although when you listen to financial company CEOs, they are very confident on the long term. The fundamentals of the loan books look good. Loan growth looks good. So there's no real, I think, systemic risk within the sector. So it becomes more of a valuation trade within the sector, company by company.